Welcome to 20 Minutes of Clarity, your go-to podcast for financial insight and advice.
I'm your host, Jason Noble, and with me today is Andy the Man Merchant. As we go into the last segment of this series, talking about what's important but not the most commonly discussed things within the financial industry, is going into this unique thing on what is happening on our side of the conversation. What I mean by that is what's going on within the industry that we want to pull the veil up a little bit so you can see more about what's going on. And this could be to advisor limitation on their platform, to what is available from an open architecture approach, to a defense mentality that we are seeing ever present more and more in this industry. As we get this kicked off, more of a conversation with you about this, Andy. It was, why are we wanting to have this on the podcast? And it was, again, just talking through what is not normally discussed. And a lot of advisors, they have just a limited platform. They could invest in stocks, maybe, mostly mutual funds or ETFs. And that's about it. And because of that limited scope, it's not really discussed with their clients that I can only do these things for you when the industry is way more broader than that. And this is something that I keep on seeing, and I'm seeing this with the major names that are on the news or on the TV all the time doing advertisements. It's like, we do mutual funds really well, we do ETFs really well, but anything outside of that, we can't really help you with. Mm-hmm. And so how have you seen like a limitation from the advisor's platform impact clients over your time in this industry?
Well, I mean, the biggest one is what we're handling here is that a lot of advisors, and this is what we're cautioning a lot of our listeners and viewers out there, and I hope everybody sticks to the very end because there's some really good content packed in this one. But to put it off is most advisors today, just in the consolidation of investment strategies and management teams, are getting a very, call it off-the-shelf product, right? And so it doesn't matter. I mean, if you've got a $10,000 investment account because you're just starting off, and it's in an IRA, or if you've got a $10 million investment account in your super high tax bracket, it's like we're starting to see advisors are just kind of using the easy off-the-shelf option, and limiting some of the other strategies are out there. And that's just not right, and they're not telling their clients necessarily about all of the different investment solutions that are out there because maybe A, they don't understand it. B, their firm doesn't support them with it, right? A lot of firms in their compliance departments have a lot of roadblocks in the way from presenting it. And then finally, it's about understanding education. So it's really important as we talk today and throughout the rest of this conversation around this topic is that you have to understand and start asking the questions around the full solution in the investment space, and don't just rely on a model portfolio based on historical performance in a model that everybody goes into. There's nothing tailored to you about it. So that's the big thing that I'm seeing out there is just advisors are taking the easy way out for clients because it's the path of least resistance. And that turns into probably not the best investment solution long-term for the client.
Yeah, and you can see this on your statements where you see moderate growth as far as the strategy title. Okay, that means that people meet certain criteria and they have this time horizon that their compliance department says you could put them into a moderate growth strategy. And that's the same strategy that everybody else falls into. There is absolutely no customization. Mm-hmm. And there's sometimes where you could call in and say, hey, I would like you to do X, Y, or Z. And they could go, okay, I could do that for you, but then you got to sign off on it. That's unsolicited and things of that nature. And I get that. That's part of the industry. But you also get a lot of the times, I'm sorry, that doesn't fit into our strategy. Now, they say strategy, but they could also mean model. The model is what the firm created internally saying, hey, put your money into these models that we built out that we're going to do with all these other assets that from other clients across the country. Mm-hmm. So is there really a customization aspect that's in there, or are you just part of a model that the same thing that you have, maybe the neighbor across the street around the corner has, when you have a totally different financial situation, but you have the same age and time horizon for retirement or whatever it may be.
Yep.
So bringing this out to light, that's where I used to work before I came over to Prime Capital Financial. I worked at a firm where I had to use models, and if I ever wanted to customize it, I couldn't unless they had over $3 million. And even then, it was like I would rather get a bill passed through Congress right now than to try to customize that strategy at the last firm I worked at, right? Yeah. To kind of show you the level of issues that I had and hurdles I had to go through. But here we could customize, and we have to explain how and why. Obviously, we work in a highly regulated industry, as it should be. Mm-hmm. But we have an open architecture here at this firm. And because of that open architecture, we work with some of the biggest names in the industry. We're not just reliant on our internal strategies or models. We have external strategies. We have external, what they call SMA, sub-manager accounts, that we could be able to go in with not just a shotgun approach, but come in with a scalpel, make those tweaks and adjustments specifically to the portfolio that customizes it right to the client's financial plan.
Yep. I would add too, real quick, Jason, on that. It's trying to give that advice back to all those that are listening today and viewing, an actionable, as we talk about on this. Ask your advisor, right? What are you doing in order to stay ahead of the trends in the industry, right? Because I love what you said here, and I think this is an important comment to make, is that in the process internally, behind the scenes, right, is that when we meet with an opportunity client, we look at their time horizon, we look at their kind of their asset level that they have in some cases, accredited, and some other options there. But then we also then send them, everybody's out there listening or viewing this knows that they fill out this wonderful little questionnaire. It's called a risk tolerance survey, right? And it takes a measurement of how you feel today. We then take time horizon, which is your control, right? Your information. We take your asset level, which just tells us what kind of investments you may be eligible for, or model minimums in many cases. And then we'll take your risk profile. All of that information then just says, okay, based on this, we're going to put you in this boring, traditional option. Now, boring is sometimes good. I don't talk negative on that. Sometimes a core model management is what people need to get it to eke out the target return they need. But my point of bringing this up is that if you're not staying ahead of a trend, if your advisor is not looking at what's out there, you don't want them to be reactive. And all they're selling you is based on a strategy that is designed around risk and time horizon, right? Without asking you with really any questions or involving you in the details. So don't limit yourself. Ask your advisor, put them on the hot seat and say, hey, tell me a little bit about it. I know I've got a good portfolio. It seems like we're in good model management. We've had good past performance. Tell me what you're doing in order to stay ahead of the trend that's happening, because I pay you a fee to make sure that I'm ahead of the game. Otherwise, why not you just do it yourself?
It's a great segue, Andy, going into another trend that we're seeing in this industry is more and more money flowing into private investments, alternative investments. And so now there's a study that was done by iCapital that says that only 33% of all financial advisors even have access to the private markets. Again, I was limited at prior companies I worked at. I was limited on this. I saw the trend at another firm, and I said, okay, hey company, can we start doing this? And they're like, no, straight no, like not even. I mean, it would have been nicer if they would just like, let me think about it. So I had at least a glimmer of hope that they will consider it. No glimmer of hope. They just shut it down, right? But I started interviewing other firms, not just for myself, but for my clients. I wanted to have an open architecture approach. Thought that was very important. And I wanted to work at a firm that also sees the trends and starts working towards that. Mm-hmm. We do that here at Prime Capital Financial. And I was able to then have the conversation with our chief investment officer over the private investment platform that we have. And so that was a big driver for me to come over. It was not the only, but it definitely helped so that I could then start offering the private investments to my clients. And they were able to benefit from this. I mean, the public bond market, for instance, is coming in around 5.25% right now on the yields. and you had a private credit fund that we have access to, and we're not going to name names. That's irrelevant for this podcast, but it's coming in at 10.3%. In 2022, it was coming at 8.1 when the bond market fell 17%, right? The aggregate bond market fell 17% with a yield of around 3, right? So, okay, so they were negative 14%, while this private credit investment, it did go down in value about 5% with the yield of 8, had a positive return of 8. Compliance is going to, Jennifer, I love you. I know you're going to have a question on this part of the segment, but I'm not saying the name. Right. And I'm doing that very tactically for this reason. The name is irrelevant. I'm just talking about the benefit that could come by looking at alternative investments versus just the public market. And we don't have the knee-jerk reaction that we see in the private markets as we see in the public markets. And it allows us to navigate this tumultuous environment. I mean, when I say tumultuous, very volatile. I mean, the other day, at the time of this conversation, Intel dropped 28% in the morning session. If you don't think that's tumultuous, then I want you to go to Clear Picture Financial, okay? I want you to enter in your information and explain to me what is tumultuous if that's not tumultuous, right? As we go into the back half of this year with an election that I believe is going to be contested. Will pull us back on track, Andy. The open architecture platform. Yeah. I want you to pick up from where I left off and take it to where you want to take it.
Well, I really like the idea of explaining, as I was just mentioning, a lot of our clients have risk profiles, and risk is very important in our providing, clients with options and investment strategies that meet their needs. But when you sit down and you really boil, again, less known topics that are equally important, is let's have a conversation around what risk is. We've talked in past podcasts, which you can go check out. We've got great white papers on it. There's risk tolerance and there's risk capacity. Those are more retirement. But in this case right here, the job of an advisor is to help a client achieve the return that they may need in order to support their lifestyle, right? That's what we do, but do it in the smoothest path. You just mentioned, if you owned Intel, right, the swings they're violent swings. Nobody wants to open up their portfolio and see, wow, I just lost 28%. That's diversification. I'm assuming in this case, if you owned all of Intel in your example, then, in that case, you would have been like, oh, crap, that's not a good feeling. But then the next day it could bounce back up. That's volatility, right? And what private investments do, what protection-based assets do, and a complementing a diversified portfolio is they just take out those spikes. So I point out this because it's when in my conversation with clients, it's like, we want to have that risk profile. We want to understand. But then I ask them, is it the risk that you're worried about, meaning you're worried about losing money, or is it the volatility and the swings? Because investing is long-term, right? We could take the stock market 10 years ago to today. Is it higher or lower, right? So we didn't lose money, if you bought the S&P 500, but there's been some volatility along the way that we've all felt. And so our job is to smooth out volatility, and that requires you to have a full tool belt of options, not just limited. You don't hire a contractor when they show up to your house to do a deck remodel or something else, that here's our game plan. I've built 10 of these decks in the past. To date, none of them have fallen down, right? But the way I do it is a screwdriver. Like, you're going to be like, well, how are you going to cut it? How are you going to do all this stuff, right? So you want somebody that's got a full tool belt and has maybe studied how other people have done things, trends, and where they're headed to make sure it stays longer and lasts longer. So that's my only addition, is that you got to stay in front of it. You got to follow the trends.
Got a great story on this topic. I mean, I had a client that bought a particular stock in the early 2000s for about $4,000. That's all he put in. That's his cost basis, is $4,000. It's worth $800,000 now. Okay, so significant growth. And he says to me the other day in a meeting, I don't have the same patience as I once did. My time horizon is not as long as it once was. And I can't stomach seeing the volatility on the stock anymore. I react to it differently than I ever have before. Right. And to think that he could lose basically 97% of it and still be ahead is crazy to think about. But what we were able to do, Andy, is take a look at doing an option strategy. And we work with a third-party firm that specializes in just option strategies. So it's not like this person was subject to my experience with options. No, working with an entire organization that only does this. Okay. And we were able to put together a proposal to show, okay, if this position drops 20%, you go down 9. If it drops 30%, you go down 9. Drops 40%, you go down 10. And like, okay, so the position itself will still go down, but the option strategy will go up in value, so his total loss is 10% in a very extreme pullback. And he goes, what would I do with that option going up in value? And I said, well, if you really like the stock and you plan on not selling it, buy more shares at a lower price point. Now this was representing about 15% of his portfolio, so we're taking on lower risk other areas. But in the conversation, he goes, okay, so if I'm lowering my risk now on this 15% because of what you're doing with the options, could we increase the risk in other places? The answer was yes, we could. Then it goes into should we? That's not for this podcast though. That was between me and that client. What I'm getting them back at is think about like these stocks that have massive gains over the last couple of years, and people were able to buy in at lower price points. Why not take some risk off the table and being able to do this? And the reason why not is your advisor doesn't have access to that type of approach. That's why not.
Yeah.
But we do. And it's because we have an open architecture approach. We could use third parties that specialize in something, Andy, and I know you do the same thing.
Well, you're so open-minded to it. It goes back to our theme again, less known topics, is what is your advisor doing to stay ahead of the trends? You know, that was something that you went out, you said, hey, I got clients that need this protection. What are we doing to be able to be proactive in providing downside protection in a market that has run for a couple of years, especially some key stocks, right? Many of you might own certain names that are out there that have just gone from nothing to something. And now you're like, now what? You know, and I always use the common kind of the phrase out there, you know, it's like great market returns are great until the market decides to take it away, right? Or taxes. So you can either pay taxes in a non-retirement account, or the market can take it away, or you can take an advisor like you, Jason, in that case, and like what we do under the Clear Picture Financial model, and go out there and you search for it. You're like, there's got to be a better solution, right? And that kind of ties into maybe the transition as well. And if any closing you can add to the back, but it's like you got to have the right mindset, right? Clients then generally will come in and say, I don't know anything about options. I don't know what you're talking about. You know, I've heard options are risky. I've heard private investments are risky. I've heard annuities are bad, right? This is the call to action for you listening and viewing this today is you have to have an open-minded, you have to trust your advisor. You have to trust what they're saying, and you have to, more importantly, trust their advice so that it's proactive. And what I think we're going to segue into is avoid, the less known topic, is avoid defensive advice that a lot of your, I call them the sideline advisors who come into play that try to protect their revenue, right, their relationship by just telling you why the deal's bad, but they never knew it. And then they just get mad because they didn't bring it to your attention. So I want to dive into the final few minutes with that, but just wanted to wrap up anything or add anything else on your end, Jace.
Yeah, this is where you go to clearpicturefinancial.com. You could look at the white paper off this topic. You could look at other videos. You could subscribe, like, and follow as well so that you're staying in touch with the things that we're discussing. So the last part of this conversation is going to the defensive mindset that we're seeing from advisors within the industry. Instead of a collaborative mindset and coordinate and collaborate with other professionals. This was discussed at our conference with our founder of the firm saying, go out there and collaborate with other advisors. Think about that kind of growth mindset that's involved in that versus we're going to have a guns out mentality. Everybody else is just evil, right? They all stink or whatever. No, go out and collaborate with the things that we're doing that others can't. That's how we could partner. But it's hard to partner with an advisor that has a defensive mindset. Can you share an example of this and a story? Because I think this just happened recently with you, right?
Yeah, I don't get into too many. I feel like I play really nice in the sandbox, you know. You know, at the end of the day, we understand. You know, going back to the first start in this story, we'll be quick. You know, we understand that the public market access, the things that we own, that we buy as a firm, that our investment team does to any other investment team, the off-the-shelf items, they're going to be pretty darn similar, right? There may be some tailoring of how much we own, but truly these advisors today and these model portfolios are using over diversified strategies. Our firm uses them as well, right? Just to keep it to where it fits their risk profile. But when we start to bring in these conversations, I had a scenario, right? And this is where defensive advice could lead to the client losing out in return, because my strategy to this client who works with another advisor was, I feel like we should redistribute some of your assets into more of our PPP, our asset location optimal modeling. We should, right now you're 100% public in markets. We really feel that it's important for all of our clients that we help and guide along the path, have some protection-based assets and some private-based assets. Well, after I present those solutions to the client, we have a great modeling supported by the clear picture analysis. Everything we do is around the why, not the what, and send it off collaborative nicely with this advisor, just simply, who's been really good along the way because we haven't taken assets out of their portfolio management. Now, all of a sudden, the recommendation is, Mr. and Mrs. Client, we should probably move a percentage of your assets into these strategies. Here's how we would do it. And, if your advisor is not bringing this to your attention now, they probably shouldn't earn the business to be able to implement what we discovered. So long story short, to make this 20 minutes meet the deadline, we sent the request to the advisor, or not the request, a statement of what we're doing, turned into multiple emails that included the client, right? We're sharing some laundry out there that were probably not professional on there, purely about defensive, stating incorrect stats and facts about the investment strategy that we proposed, all because they didn't know, right? So they became defensive in their response because they were losing wealth, even though they were maintaining a big chunk of their public allocation. We didn't cut them out. We just offered something they couldn't offer or weren't proactive in offering. Led to the client now being confused, right? Trust both parties. And now they're just stuck in this paralysis mode, not knowing what to do, right? All because the advisor decided to think about themselves, and my opinion, losing the assets without having the full access to the tool belt. And they had plenty of opportunity in the last year and a half to be proactive in incorporating these strategies. So be very careful.
But if the advisor was more open-minded, if the advisor was more collaborative, it's like, you know what, for you, Mr. and Mrs. Smith, we're looking at this. Yes, it makes sense. I'm glad that you have Andy as another resource. Here are the negatives of doing this. Here are the benefits of doing this. Those positives outweigh those negatives. Let's go ahead and let's start the process and make this a smooth process.
Yeah.
And then, okay, what does that client do now? It's like, okay, I got true trusted advisors who are working collaboratively for the betterment of my financial future. A lot of my clients have multiple professionals that I collaborate with.
Yep.
Attorneys comes to mind, accountants. I feel like there's sometimes of the year I talk to more accountants than I do with clients, but it's because we're trying to wrap up a year and prepare for the next year and do tax planning and everything else that we focus on within our clear picture analysis and our optimal scores. So that was just another 20 minutes of clarity. You just heard from ATMs, Andy, the man merchant. He just spitting knowledge and sending out cash out there, not doing it illegally, IRS, okay? And I am Jason Noble. Thank you so much. And tune in next time for a whole new series that we're going to jump into.